Welcome to the Ultimate Guide to Investing, your blueprint to building wealth, making smart decisions, and avoiding the traps that sink most investors. In this 5-part video, I'm going to give you 5 chapters. This video is good for anyone at any level, whether you've not yet invested or whether you've been an investor for years. I think you're definitely going to learn something from this video. If you're very beginner and you've never invested before, you should definitely watch this video, but you should also watch my guide here, which is my beginner's guide to investing. I'm going to cover some basic concepts in this video too, so don't worry. In this 5-part video, we're breaking down investing for beginners to deep behavioral insight. Here's what we're going to cover. Chapter 1, investing for beginners. Simple tools like dollar cost averaging and compound interest. Chapter 2, index funds versus stocks. Which one should you invest in? Backed by data, theory, and Warren Buffett himself. Chapter 3, crypto versus stocks. Diversification, risk, and portfolio theory. Chapter 4, the psychology of investing, how your brain tricks you and how to fight back. And then chapter 5, why most investors fail and how you can be the exception. Let's dive into chapter 1, investing for beginners. If you're just getting started, here's the golden rule. You do not need to be rich to invest. You become rich by investing consistently and smartly. A great concept is something called dollar cost average. Rather than trying to time the market, dollar cost averaging means investing the same amount at regular intervals. Say $100 every month, whether the market's up or whether the market's down. This smooths out your buying price over time so that you're never buying super high, you're never buying super low. This removes emotion from the equation. Another concept in why investing is so amazing is compound interest. Albert Einstein even called it the 8th wonder of the world. Compound interest is when your gains start to make gains. It rewards patience more than genius. Start early, invest regularly, and keep the money in there so that all your gains will make more money and more money and more money, and so forth, and time will do the heavy lifting. But let's be honest, the hardest part of investing is not the maths, or math if you're in the US. It's you. Behavioral finance shows that we're wired to make bad decisions with our money because sometimes the best decisions are not intuitive. Panic when markets drop. We chase fads like NFTs and crypto. What is one solution? Well, use investing apps. Use investing apps that automate your contributions every month and add them to basic index funds such as the S&P 500 and the FTSE 100 in the UK. If you're in Spain, this would be the ESP 35. When you invest regularly, dollar cost average, and use apps to automate your investments, you remove emotion from the equation. You don't even need to look at your account and it will just grow over the long term. We will come on to more about the psychology of investing in chapter 4, so stick around for that. All right, chapter 2. Index funds versus stocks. Can you beat the market? Probably not. Here's why. Efficient market hypothesis. According to the efficient market hypothesis, stock prices already reflect all available information, meaning by the time you buy, it's already priced in. So if you're trying to outsmart the market, you're probably just guessing. Professional investors who work in hedge funds are shown to not even beat the market. They do not beat the index funds. And this is why I always say index funds are the best return on investment because they're lower risk, but you still get a pretty decent return. And this brings me on to the Spiva scorecard data. Don't take my word for it. 85 to 90% of actively managed funds, so this is funds that are managed by professional investors, underperform the S&P 500 over a decade. That's not just bad, that's statistically brutal. And it shows you do not need to be a professional investor. You just need to be aware of which index funds to invest in. So the S&P 500, often this has the ticker symbol VOO. If you want to invest in the Vanguard S&P 500, make sure if you're using an app like eToro that it's not a CFD because they give you extra charges for this. But just type in S&P 500, you'll get a whole list of S&P 500 index funds. Choose one that's not an SFD, automate $100, $200 per month, done. Easy. In 2008, Warren Buffett bet $1 million that a simple S&P 500 index fund would beat a portfolio of hand-picked hedge funds over 10 years. He won easily. The takeaway: low-cost index funds outperform expensive, actively managed funds. Keep it simple, keep costs low. Warren Buffett is the expert here. If you want to look into him, if you already don't know about him, he made 90% of his wealth in the last 10 years, and he has been investing for decades. He is a multi-billionaire, and he made a lot of this through investing in index funds. Chapter 3, crypto versus stocks. Is crypto the future? Maybe, but here's what you need to understand. Looking at modern portfolio theory, this theory says that non-correlated assets like crypto might improve your overall returns. The key word here is might. We do not know. It's still a very risky thing to invest in. And this is why I always say index funds are the best, because if you're risk averse or you just don't want to lose a lot of money, index funds are going to perform the best over time. If you're planning on leaving them in there 5 to 10 years or more, 100% index funds are your best bet. Some people use crypto for trading, which is short-term buying and selling, but this is for the professionals. This takes a lot of research, a lot of investment, a lot of time, and people do trading for a living. But this is such a niche thing. If you have a day job and you just want to invest, it's really not worth investing in crypto, because most likely you will lose. Crypto is not correlated with stocks, but it's also much more volatile. Bitcoin's standard deviation is more than 5 times higher than the S&P 500. Translation: it swings wildly. That can help or hurt your portfolio depending on your type. Before diving into crypto, ask yourself, can I emotionally handle a 50% drop? If I invest $5,000, am I happy with losing $2,500? If you don't fancy an emotional roller coaster of a 50% drop overnight, do not buy it. Do not buy what you cannot understand. Use tools like risk investment apps to define your comfort zone before investing. Also, know your why for investing. So if you want to invest for your future retirement, or you want to invest to buy a house in 10 years, you're in your 20s and you want to buy a house in your 30s, or you're in your 30s and you want to buy a house in your 40s, etc., then index funds are still going to be the best way forward over a long-term period. If you need money in the next couple of years, I always say having it in a high yield savings account where you're getting at least 4% interest is the best way forward. But if you want to do crypto, you can. I always recommend to people having 10% of your portfolio as fun money. So this can include individual stocks, this can include crypto. I, for example, have 10% of my portfolio in individual stocks, and it includes a little bit of crypto. I do not trade crypto. I just have a couple of hundred sitting there in my account. It's not something I actively invest in so that it will grow. So moving on to chapter 4, the psychology of investing. Most investing is not logical, it's psychological. Looking into loss aversion theory, which was researched by Kahneman and Tversky, they say we fear losses twice as much as we enjoy gains. So when the market drops, we panic sell. That's how people lock in losses that were only temporary. So when your investments drop, leave it. In fact, I recommend buying when it's low, because you are literally buying something that's on sale. Do not sell. Overconfidence bias is also an interesting concept in psychology of money. So many retail investors think that they can time the market. But as I said earlier, studies say otherwise. Overconfidence leads to excess trading and worse returns. Herd mentality. In 2021, meme stocks like GameStop and AMC soared. Not because of actual value, because of FOMO. Social media turned investing into gambling. Herds can run off cliffs. Do not follow the herd. Thousands bought at the top when the craze was the highest. Many people lost money. Be skeptical of the hype. Chapter 5, why most investors fail, and how you can be the exception. The sad truth, most investors fail, but you do not have to. Dalbar research shows that the average investor earns way less than the market. This is often due to panic selling and bad timing. Vanguard found that one of the best traits of a financial advisor is behavioral coaching, helping clients stay on track during volatile times. So, practical tips on how to be the exception. 1, automate your investment so you don't rely on willpower. So automate it, it comes out of your salary as soon as you get paid. Number 2, remove emotion by ignoring the news. I actually ignore the news for my own mental sanity, but if you really still want to watch the news, just do not let it affect your investments and focus on your long-term goals. Number 3, rebalance annually, not reactively. Every year, it's worth looking at your portfolio to see how much percentage is in index funds, how much percentage is in fund money, how much in real estate, and how much in cash, and adjust accordingly. As I said, I think you should have cash as an emergency fund, which is 3 to 6 months of expenses. If you need any more cash, if you're saving for a house and you really want to save in the short term, saving cash, but I think your actual investments should be 80% index funds, 10% bonds, and 10% fund money, which is individual stocks and crypto. Rebalance every year to check that you're still in alignment. And then number 4, stick to a plan based on your time horizon, not on market noise. In conclusion, investing isn't about beating the market. It's about building wealth over time. With patience, discipline, and a bit of knowledge, you've got this. If you found this video helpful, please check out my other videos. My beginner's guide to investing is here, and YouTube will suggest another video here which you might like. Click like, subscribe, and it would really help me grow my channel if you could leave a comment down below. I would love to hear if you learned anything new from this video, and I would love to know what you want to hear about next time. Drop any questions below and I will be sure to respond to you. And I'll see you in the next video.